Hello, welcome back to the Instech podcast. Zoya here. This week we're joined by Artificial and Aon, two organisations at the heart of reshaping how risk is traded in the London market. Joining Robin on the podcast is Ed Howkins, Chief Growth Officer at Artificial, who spoke at our recent evening event hosted in April, and Sasa Brcerevic, who leads underwriting transformation efforts at Aon. Together they unpack how Aon and Artificial are collaborating to digitise not just the broking process, but the very interaction between brokers and underwriters at scale. If you're curious about the future of wholesale broking, digitally deployed capital, and why competitive pressure, not theory, is finally driving real change in insurance, this episode is for you. Now let's dive into the conversation.
A very warm welcome to this week's Instech podcast. We're a threesome today because I'm joined by Ed Howkins, who's the Chief Growth Officer at Artificial Labs. Sasa Brcerevic, Aon. Welcome both.
Good to see you, Robin. Thanks for having us. Great to see you, Sasha.
Good to see you, Ed. Good to see you again, Robin. Looking forward to this.
Sasha, we've known each other for quite a long time. You've had a variety of roles at Aon. What are you up to at the moment?
Continuing focus on trying to oversee and provide guidance where we undertake underwriting activities. People in London market will know Aon Client Treaty and various other initiatives. We are looking at digitization, which is going to be the topic of today. We have big plans at Aon with respect to that. A lot of it is to do with the digitization of the broking process itself, but we're also looking at digitization of the actual trading activity between us and the trading partners.
Ed, this is your podcast. You've got Sasha as your guest, which suggests that Artificial Labs and Aon are working on something together. I don't want the details, but what can you share about the work that you and Aon are doing together?
As we are with all of our customers, we'll remain very coy, but I will just say we're working on some really interesting things. Some of the things that Sasha's just mentioned around digitising broking and digitising how risk is traded in the market.
Digitising a wholesale broker, certainly a really big wholesale broker, isn't easy. Just for the listeners, tell us a little bit about the difference between a wholesale broker and a retail broker, and then perhaps we can dive into the particular issues that the wholesale broker faces on a journey like this.
My take on that, I think the primary distinction between wholesale broking and retail broking is direct interaction with the actual insurance buyer and a degree of necessity to advise and handhold the insurance buyer through various trade-off decisions that they need to make between the cost and cover, and structure of that cover, and a choice way to buy it, and all sorts of stuff. So when an order comes into the wholesale market, by and large, the construct of what the client wants to buy has been determined. So in a way, wholesale broking is a lot more, it may sound a bit crude, but it is a lot more kind of comparable basis in order fulfillment business as opposed to retail broking that has a much, much stronger degree of advisory and guidance than a wholesale broker does. So from that perspective, a wholesale broker is much more focused on transaction execution, while a retail broker is much more focused on serving the client or the insurance buyer.
So does that make the digitization of what you do a bit easier? What are you trying to digitize and where are you on the journey?
The process is itself inside of an organization like Aon, but I think generally speaking, wholesale broking lends itself easier to digitization of those processes. So this applies not just to Aon, I think it applies to the whole market in London. And there's digitization of processes. A lot of those processes are around moving information around, which I think the market itself has been trying to do for a long time. But there's also digitization of the actual interaction between the broker and the underwriter and the obtaining of the underwriting opinion being digitized, which I think is a novel thing. The market is exploring how to find a way to do that proactively over the last few years.
And back to you, because you sit in the middle and you've got to be part of the interaction between broker and carrier. Is this going to change things for the carrier? What should a carrier be expecting in this ongoing digital transformation story?
I think it has to change things for carriers. In any kind of multi-party relationship, you don't want to be the least well informed. So if you have the top of the chain, the distribution part of the value chain being digitally driven, full of data-driven insights. You don't want to be the recipient of information that doesn't have that same level of understanding of the information that you're getting. I think the second part is carriers are starting to work out that digitization isn't a big scary thing for them. It's a necessary part of how they interact with not just the big brokers, but brokers across the market and across the value chain, both retail brokers and wholesale brokers. So I think what we're seeing with carriers now is a kind of a bit of a maturing of the almost knee-jerk reaction against, let's call it the quote and bind movement of 5 years ago, where everybody thought everything had to be in this nice little box, to a model where carriers are a bit more mature and reflective of how do we add value to our distribution partners, the big London market wholesalers, the retail brokers. How can we make ourselves the best trading partner? And technology is clearly a very important part of that.
You can't digitise on your own. You're part of a market, so you must have spoken to your main carriers, and I would guess, having been around this space, that most welcome this in the sense that they've wanted more data and they've wanted greater levels of transactional efficiency. What's been broadly the sort of reaction? Are people coming along with you on the journey?
I think so. I mean, obviously, Aon is a big part of the London market distribution, but we're not the only ones. And so any one trading partner, in a sense, they're not exclusive Aon trading partners. They trade with all the other brokers. Our read is that there seems to have been, in my mind, there seems to have been a shift change from 5, 6, 7 years ago. Used to be probably a niche topic inside of those organizations. These days, it's a topic at the very top of the organization, and there's real intent and a serious investment going in to building capabilities. I don't think there's a quote unquote a winning model of what that looks like. There's many permutations, but clearly new types of capabilities will have to be developed, and that will call for new types of sort of organizational structures, not just from a technology capabilities, but also relative to traditional way of how risk capital is deployed. And that's going to call practical challenges, not just building that technological infrastructure, but also building organizational infrastructure that enables you to actually act efficiently using those new capabilities. And everybody's operating in an ecosystem with multiple competitors and multiple trading partners. And I think what's given an impetus more recently is a realization that there is a competitive race. It's not quite clear. I don't think anybody has a crystal ball so you can project into future, but it's not quite clear how the competitive angles will play themselves out. Self-evidently, looking into the market, the entities who have squarely leaned into digitization have been able to make meaningful inroads on it, competing effectively. And I think that causes everybody to pause and think, okay, this is not just a theoretical discussion of digitization that the whole market has been having for decades. It is real, it is happening, and there is an impact from a competitive landscape perspective, and one needs to respond.
Presumably you don't need the whole market. There's always a sort of progressive end of the insurance market, and they'll be coming with you, and they've long awaited this, and then there's always those who come behind. What's your approach to that? What sort of proportion of the market do you need to be able to take with you on this journey, or do you need everybody? I mean, how does that work?
I think Aon's perspective is Aon isn't going to choose or dictate to trading counterparties what they should do. I think clearly if there is a more effective and efficient way of trading certain business, and I think what happens is that the competitive pressures kick in really quickly. And the entities in the market will be reading those competitive pressures and will be observing, and there will be a very simple observation. If I do not develop these capabilities, I'm staying behind the times. It is a real, I am not seeing the flow. And I think that those competitive pressures will simply move the whole of the market, and it probably will become an inflection point where it moves pretty fast. In the very, very early days, it might appear that the adoption is maybe going slowly, but at some point in time, to your point, to some point in time where there's enough liquidity, able to obtain an access through different channel, then all of a sudden quite a lot of flow will flow that way, be it Aon flow, be it other people's flow, because it is just an easier way to do it. And then I think that will spurn those who have waited that they will just have to move along. And I think the whole market will adopt this pretty quickly.
FOMO is a very powerful influence, and Mo actually missing out even more powerful, I think. And for the carriers, on the carrier side of things, this isn't just about a simple upgrade in the tech. You have some interesting observations which I'd like you to share around what you think is happening in the carrier market, or it's like to be the natural evolution of how carriers will evolve in the light of all this.
Thank you, yes. And I think it's maybe one for discussion with this group. So it's one of the trends of 5 to 10 years ago was there was a lot of talk about insurers, not reinsurers, insurers becoming risk transformers. They would source risk from the distribution chain and they would underwrite it, they would package it up and sell it on to reinsurers. And clearly that's what happens now. But with the Fidelis bifurcation of underwriting into an MGU and balance sheet into the insurance company, I think we've seen that sort of clearest first person over the start line in that race of what does the insurance carrier of the future look like? Is it a risk transformer that provides one of a few things, access to distribution, underwriting intellectual property, really effective risk transformation into the capital markets, whether that is a traditional reinsurance balance sheet or a less traditional third-party capital provider. And I think the key thing that has started to unlock that potential for more than just Fidelis has been this digitalization of underwriting of really complex risk. It's also the digitalization of flow from distributors. So if we've got what Sasa's talking about, brokers starting to package up risk and pass it through the market in a more digital format, the carriers that get there first as digital carriers are the first ones likely to be able to transform that risk into whatever financial product they need it to be to hit their return metrics. So whether that's, as I said, via a reinsurance carrier, via other carriers. So we've got this new fangled portfolio underwriting. That's just insurance quota share underwriting, or the London Bridge and third-party structures coming in. And I think it's a really exciting time for the market as we test out these new ways of transforming risk across the value chain.
Yeah, I don't think this is even left to opine on. It's self-evident by observing. There are, relative to, let's say, 10, 15 years ago, where a traditionally distributed risk capital was via rated insurer balance sheets, occasional participation of sort of third-party capital via sidecars, tactically responding to market cycles. There are so many permutations of how individual risks are tied or paired with the ultimate risk bearer capacity. I think, to Ed's point, the market is testing it. What the winning model is going to be, I think we often compare ourselves to the capital markets. There is a fundamental difference between capital markets and insurance. Ultimately, we sell a product and we create a relationship between that risk-bearing capital and the buyer that endures beyond just purchase point in time, because there's a claim to be paid at some point in time and the client is interested, who's going to pay my claim? Not only who they are and how they will act, but also will they be there whenever I need that payment. I can definitely see that there are advantages to a hybrid model with tied capital, but tightly coupled and partnered with long-term partnership support of risk capital through time, that allows an entity to maintain their presence with their clients, with their distribution partners through time and through the cycle without having to respond to the cycle so dramatically with their own balance sheet.
It's also a lot more intentional this time, isn't it? So previously, I don't know if it's felt like people have not quite sleepwalked into it, but happened. And now it feels like people are intentionally testing things. It's intentionally trying an MGU, intentionally bifurcating into lead and follow, intentionally building a portfolio underwriting team, intentionally delegating more or delegating less. And yeah, that sort of actual testing is much more likely to lead to some kind of proper robust outcomes. And no one knows what those outcomes are, but there is going to be an outcome as a result of this intentional testing.
Sasha, there's a lot of change going on. How does Aon look at this? Is it something it relishes, or is it something it fears? Is this an opportunity for you, or are you doing it defensively?
spending much time thinking, are we doing this defensively or offensively? We don't spend much time talking about that. Look, it's a change. It's a change for us internally. It's a change for the market. So any change will require investment, and it's seen as a conviction that the way the market operates and the way that we have to compete in order to stay relevant today is going to have to be different, not on some sort of nebulous future that we can intuit beyond the horizon, that it's right here in a few years' time, and requires proactive investment. And it's a big part of our well-publicized restructuring that we've undertaken over the last couple of years. A big part of that investment is building out internal technological capabilities to completely reimagine how the broking process works. What is the best of breed broking process, leveraging new technology for a large globally integrated broker? And that absolutely, we see that as something that is going to enhance the existing competitive edge that we have today. I think we talk a lot about its change and effect on market participants, but I think it's worthwhile taking a step back and thinking, what's the net effect of all of that? I think that the net effect of all of that is that eventually the whole system will provide a much better service and a much better product to the buyers, to the clients. Right? I don't think that this change holds a key to a sustainable, persistent increase in margin on any part of the value chain, because again, that would assume that the pressures are somehow reduced. I don't think that happens. I think it's just simply that this industry is going to be much more efficient and therefore be able to provide the service and the product to its clients in a much better way, much more smoother way, much more sort of 21st century feel of a product and a service than we currently do. And that's a good thing.
Ed, what do you say to old skeptics like me who say we've been talking about the digitisation of the market for 25 years? There's been a few false dawns. Why would I get any more excited about this version than any other version over the last generation?
It's a great question. I think it's probably the first time in this industry where basically all the market participants are pushing in the same direction, and broadly everybody has a positive outcome, and a positive outcome of pretty similar quantum. So gone are the days of this sort of straight through risk arrives from customer and then suddenly is on a balance sheet. Everybody has got past that. Now there's a proper understanding of the place of each participant in the chain and the need for each participant to have a slightly different version of digitization with a slightly different set of inputs and outputs. And broadly, because everybody is getting benefit at the same time and different benefits, there is a collective push in the same direction.
Presumably there's a point around the technology being fundamentally better and cheaper, which means that people, once they make these commitments, are able to implement something. I look back to my original RI3K business. The tech that we built it on 25 years ago wasn't very good. It cost tens of millions to build. It's all changed now.
Yeah, you're absolutely right. And the investment that has gone into now, the years as well, it's not just money investment, it's time investment, but also the people building technology now are typically of the industry. So I think one of the reasons, and I won't talk about artificial very much today, but one of the things that we've realized is a really differentiating factor about us is we've got really smart people to build the technology being supervised by people who really understand the full complexity of the market and who also understand the bits that they don't understand. And by that, I mean, there are big gaps in everybody's knowledge set of the market. And what we're very good at doing is finding somebody to help us fill those gaps. So we work really closely with our broker partners. So if we take our contract building tool, which has been very successful in the last year, 30,000 policies on it, tens of billions of dollars of premium, that has been collaboratively developed with our broking partners. So we have a little broker advisory board, and the participants of that have really helped us fill in the gaps of that product. And that's what we do with each of our customers. It's work with them. We don't sell them a box that looks the same for every customer. Every customer has their own box. Some people buy really big boxes, some people buy really small boxes, all for different purposes. And you can only do that with technology if it's really configurable, if it's really quick to deploy, but also if it isn't a big investment. If you're talking about £500,000 rather than £25 million. And if you're talking about 4 weeks and not a year, those are really big differences, and allow people to, as Sasha described earlier, make those first steps. They're able to test stuff. Sure, there's a bit of an opportunity and temporal cost, but it's not as big as it used to be. And that means people can get on and try, and it becomes a really exciting snowball throughout the value chain.
I think if I can add my read on what's different now than 20 years ago, Robin, this may be slightly unfair to you, but I think it was largely a theoretical discussion. Hey, theoretically, this market that is made up of many participants that do many-to-many interactions with lots of sort of interchange, isn't that logically then, if that was digitized and all of that, incredible frictional costs removed, and so theoretically that made a lot of sense. But I don't think cost of access to technology at the time certainly made it difficult to do that. But also the conversation was limited to very small number of people who were interested into it almost out of personal curiosity, rather than what I think there is a real difference today. And this has been driven by the drop of an availability of technology that has allowed a lot of different people to have a go. A lot of people who are seeing this as an opportunity, people are acting not out of some sort of a charitable play. The ecosystem would be a better ecosystem if we all did it. People are acting out of, if I don't do this, I'm bound to lose my competitive edge. So I think that there is no motivator as strong as seeing, if I do this, I'm actually going to proactively cause my competitive position to suffer, and I have to do it.
Well, I'll forgive you for the notion that I wasted 10 years of my life on something that was entirely theoretical, and I'm sure the shareholders who pump tens of millions into it will do the same. Look, we need to round things up. Ed, you're facing a huge opportunity here. You're beautifully positioned. You've got the right sort of tech at the right time. What's the opportunity? What are you investing in? What can you tell us?
Yeah, it's a really exciting time for the market and for us in particular. We've got 2 product verticals, one serving carriers, which we've had for a long time, and we've got some high profile clients in that space. And really that's about helping carriers to deploy underwriting capital in the most efficient and effective way. So we've moved well past the follow only space. Any kind of underwriting, we will help you do it. We're fully configurable. Importantly, that allows you to control and deploy your underwriting IP to whatever distribution opportunity you want. But really excitingly, I guess in the last year or so, then we've been in the process of launching our smart placement tooling, which encompasses Contract Builder, which is live across quite a big portion of the market, risks now. But smart placement is all about taking out operational friction for brokers, enabling them to place risk more efficiently, more effectively, but also in a more data-driven and rich way. And we started talking about that publicly in October, November time last year, and the take-up of that has been rapid. So as per usual, brokers have seen the opportunity fastest. They've got a very short sales cycle, which is great for me as Chief Growth Officer, but also they are pushing the boundaries of what you can do with technology. And this has been the most interesting observation we've had. The second you deploy technology into a brokerage and they see that it's working, the first question is, what can we do next? And that's a really exciting place for a business like us, where we keep asking the what's next? How do we make this better? What are the next bits of your process that we can optimize for? How can we make you the smartest person at placing this business or structuring this risk? And so for us, it's a continued major investment in our platform. It's the rollout of a couple of really big partnerships, which you'll hear more about in the next couple of months. But at the same time, it's also not forgetting that where we came from was that carrier space. And just to touch on something I said earlier, carriers have really started to mature in how they think about deploying capital. So let's just say digitally deploying capital as the proxy for having some sort of machine, whether it's algo, augmented, you name it, we can do it. But everybody's realizing that they need a slightly different model to one another. They need to find a way that works for their position in the market. Lead underwriters behave very differently to follow underwriters. Underwriting businesses that have both lead and follow need to underwrite and behave differently to those that don't. And so working with our carrier partners to enable them to deploy underwriting capital across the spectrum of their underwriting strategies is a key part of this year for us as well, and incredibly exciting.
Very interesting. Sasha, we covered a lot of ground there. What last thought, last bon mot would you like to leave our audience with?
Just reflecting on what Ed was saying, the biggest structural change that will fundamentally affect how all of our businesses and trading partner businesses are shaped is the fact that historically, the cost of obtaining and providing an underwriting opinion was dramatically high. And to the point that Ed was making very directly, which is that the underwriting decision making is being digitized, fundamentally has an effect of dramatically reducing the cost of obtaining and providing an underwriting opinion on a risk basis. How much of a market that will capture, who knows? At the end of the day, I think, again, the competitive pressures are very present at all the levels in the value chain. I see this sort of expanding in scope and grabbing as much of a flow as the market can see that it can be done safely. How far that goes, nobody really knows. We'll see. But I think if we are looking at other industries where analogous type of complexity of decision making has been digitized, it's probably prudent to plan that this becomes a large segment of the market over time, and not so much over such a long time. Once it becomes available that you can do the same thing much quicker, much more certain, with much better service wrapped around it, for a fraction of a cost, the attractiveness of that just becomes a snowball.
Last word with you, Ed. What thought would you like to leave the audience with?
To be honest, it's quite difficult to beat Sasha's incredibly eloquent summary of the opportunity for us, but also the opportunity for both brokers and for carriers. I think maybe just to summarize the next steps, there are a lot of participants in the market who are, I would describe, in their swimming costumes, stood on the edge of a pool. They know that the pool is a nice temperature because a few people have told them it's a nice temperature. They can see a little thermometer gauge. All they need to do is jump in, and it's better to jump into a pool than to be pushed in. And the more people that start jumping into that pool, the better off everybody is going to be.
Well, I've really enjoyed that. Thank you too for indulging me on my subject. You've given me a lot to think about, not least the idea that I wasted 10 years of my career in something entirely theoretical. But worse things have happened. There's an existential crisis late in my life. Thank you both for supporting Instack. I wish you well. These are really exciting times, and I'm watching both organisations with complete fascination. Thank you both for joining me.
Well, if you've made it this far, then I'm pretty sure you found that as interesting as I did. The Instack podcast comes out every Sunday morning, where we spotlight the latest news, leading voices, and freshest updates across insurance that you need to know about. If you would like to take part in these conversations, head to www.instech.co to find out how you can join our network and be a part of the insurance intelligence for the curious.